Good afternoon. Welcome back to the latest edition of the InvestTalk market analysis for the week ending January 27th, 2023. Thank you all for tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video, Rising Liquidity Brings Out the Bulls as the Fed Looms. Now, I'm Justin Klein, CEO of KPP Financial, and I'm going to dig into some of the data per usual. I really like this dashboard. I think I'm going to use it all year. And first, we'll start at the top left. What you can see here is the growth side of the market is starting to outperform this month. And that's what's really driving prices over the last month higher. Now, there's two parts to this. One is certainly liquidity dynamics improving, which I will show you right here. Here's the National Financial Conditions Index that is now in decline really since October. Remember, we talked about the pessimism on October lows. Behind the scenes, the Fed pivoted due to strengthening dollar, and the Bank of Japan, they also raised their rates, so that strengthened the yen versus the dollar, kind of brought liquidity back into the system, and you can see that by this index. And so that's certainly going to help the riskier parts of the market, which is obviously the growth side. And then you also have a reprieve from tax loss selling. So what you can see over here on the right are the sectors that have done the best over the past month are mainly the sectors that have done the worst over the past year, right? So while consumer cyclical is the best performing index over the past month, it's still one of the worst, down 13.6% over the last year. Same with communication services, right? Just behind consumer cyclicals, but still year over year down about 23%. Technology up, that's third, but also down double digits. So you can see all of these sectors, even real estate, nice little bounce back, but down 10%. All these sectors that are down 7-8% year over year, they're the ones getting the highest bounce. It means there's a lot of tax loss selling at the end of last year. That's why you kind of had the pullback in the markets last year, into Christmas time. And that was the pressure and now that pressure is relieved, right? So people buying back in after they sold 30 days, they sold early in December. And now it's been 30 days, and so they're buying back positions. And just in general, not the selling pressure that they were feeling in December. So let's give this will be a lesson to you that some of the best performers, especially early on in the year, are some of the worst performers the year before, especially if you're in a large downtrend where a lot of people have losses. So a quick lesson on that front. Now the yield curve over here on the left, that's still inverted. No real change overall, still inverted out to about a year. On the week, market was nicely higher. So overall, still very positive. On the back of like I talked about last week, is the debt ceiling being hit and no debt being issued, meaning no liquidity being pulled out of the system, but the Treasury General account continuing to be drawn down, and that pushes liquidity out in the system. And next week, though, we do have the Fed, and the Fed is looming. And what's interesting here is these are the odds for the Fed meeting on Wednesday and their release. And what you can see here is it's a 98% chance they're going to go to a quarter point. Now, a week ago, what you would have seen here is this on the left side, and a very small chance, right? It's called a month ago, a very small chance they were going to pause, right? Now there's a 1.6% chance they're going to pause and not raise rates. There's a 0% chance they're going to raise 50 basis points on Wednesday. That's what the market's pricing in. So we're still probably going to get the 25, but you can see the positioning that's shifted over the past month from a 32% chance a month ago that we were going to have a 50 basis point hike now to a 0% chance. And only a 67% chance we're going to get 25 basis points. Now it's basically guaranteed. Okay, at the slight chance they'll get a full pause. So that's another reason why you see the dollar weak, you see financial conditions weakening, etc. And then you go to the March data point, and a month ago, there was nearly a 0.25% chance that the Fed funds rate would go from 4.25% today all the way to 5%. So you're talking about 75 basis points over these next two meetings. Now there's a 0% chance, okay? And it's more likely that we get that 50 and 25 and 25, and we have an 84% chance it's going to be 50 basis points over the next 2 meetings. But now you go from a 0% chance that they were going to pause to now a 0.2% chance that they do nothing over the next 2 meetings. Okay. So this is another reason why you continue to see a float up in market is markets are building in the expectation of a more dovish Fed. Why is that? Well, we'll get to the economic data, and we didn't have a lot early in the week, but Thursday, Friday had a lot of release, which we'll get to. But I want to go back to this chart, which I've talked about in the past. If you go watch our webinar over the fall, talking about inflation, I talked a lot about this. And it's basically there's an 18-month lag between M2 growth and CPI, right? Because it takes a while for that to be feeding the market, to be embedded in consumer habits. You don't see money hit your bank account right away and suddenly go spend it. But it's there for a time, and it starts to flow out into the system, into the economy, and driving inflation. That's what you've seen. So what you can see here is M2 growth peaked in February of 2021. Where did CPI peak? In June of 2022. So talking about the beginning of the year 2021, mid-year 2022. So there's about an 18-month lag here. And what you can see right now is year over year, M2 growth is negative 1%, 1.3%. So you go back in history, even in the depths of the financial crisis, what is this, 94? Okay, that was 94. It was at 0.3% year over year. And same with, 2010, it was at, did it hit negative? Oh no, it's always remained positive. But you can see here what that looks like, okay, and the general lag effect. So I'm not saying inflation is going to go back to zero, but inflation, and this is the one on the right column here, it's probably headed back down to 2-3%. The question is, how sticky will it be? I think that's the big question, which we'll see. Where does it level out at? But we can see clearly, and the Fed's looking at this, I'm sure too, is hey, they don't need to tighten very much, if at all. They've done a good job of really ramping up those rates, doing QT, and bringing M2 growth down significantly. Okay, so what was the economic data this week? Well, Richmond Fed manufacturing, that was at negative 11, so pretty stark decline there. Remember, anything below zero is negative. So you have the Kansas City Fed manufacturing, that's down 4 months in a row. Okay, and this is for January. This is pretty live, right? January. This is live data, almost. Real GDP, that came out. This is pretty lag, fourth quarter, 2.9%. Quarter over quarter, which is solid. It's fine. Real GDP year over year, 1%. Okay, quarter over quarter, year over year, 1%. So we're in a very slow growth economy. That's pretty clear. Okay. The Fed's, one of their favorite measurements on inflation, the PCE, year over year, down to 5%. Okay, lowest level really since October of 2021. September, actually. So I've said this for a while. Inflation is not really going to be a story for the first half of this year. It's probably going to be a story for the second half because through, like I talked about that lag effect, you're going to see inflation continue to come down. But at some point, it's probably going to stop going down and you're going to get an up month. And the question is, when is that? What is the Fed reaction to it? What is the market reaction to it? So, but that's probably not until the second half of the year. Now, core PCE index year over year down to 4.42%. So regular is at 5, core is at 4.4. Still the lowest once again since the fall of 2021. The 12-month trim mean PCE inflation, that also is coming down, but at a slower pace. You have personal spending month over month. That was weak for the second month in a row. So consumer is definitely feeling it. Now, this is December, so it's not quite live, but pretty good indication there. The personal income, that's up. So savings rate is higher, right? Income up, spending down. that's actually, a bit of a positive. I think longer term, but obviously near term, that's going to impact spending or earnings, excuse me. And you have consumer sentiment that's hit the highest level in, a year, right? Or since April of last year, so almost a year. So clearly lower gasoline prices, still relatively strong labor market, home prices coming down. I think that's all giving hope to some consumers that things are getting a bit better. Pending home sales month over month, bit of improvement for the first time. You have growth month over month since May. And a lot of this has to do with the mortgage rate coming down, not dramatically, but to a level, about 100 basis points from where we were a month or two ago. Pending home sales still down though, year over year, 33%. So those are the economic data points and what I wanted to get to overall. But let's get into the markets. And I said this before. I said we hit good resistance on this NYSE. We retested that level and we remain like we're grinding higher. Probably into the Fed meeting, and then it's all about how does the market react? And the VIX is something I'm continuing to watch. Does this bottom going into the Fed meeting and give breakout to the upside of this 50-day moving average? That would be an indication to me that maybe downside volatility is picking up here. The S&P, that also still remains relatively strong, but retesting that 4,100 level that was tested in November and early December. So something, and that was the last Fed meeting, I believe, was that December meeting. And then you have, let's look at growth to value. You kind of know what this is going to look like because I just showed you over the past month what's happened. Well, you've seen this rebound in the growth side of the market, but still in the context of a broader market sell-off. Remember, this rallied in May, June, July, and into mid-August, and this started to roll over right before the market peaked. Remember, this peaked in early August. The market peaked in more like mid-August. Here's the S&P. So something I'm watching. So as long as this stays in an uptrend, I'm not at the IWF to the VONV. As long as this remains an uptrend, I don't think we're in pullback mode yet in the market. So something I'm going to continue to keep an eye on. And if you look at like the Vixen, this is the NASDAQ Volatility Index that remains in a downtrend, no breakout to the upside either. And then another volatility index I watch, GVZ, gold continues to grind lower. Remember, these are inversely related. Usually when volatility in a space is grinding higher, that is negative for markets and vice versa. Let's look at the 10-year. That has continued to pull back, but hit some support. Remember, this had attempted breakout, a pullback, and then actually broke out. So when you return to that previous breakout area, that is going to be support, and it has been support so far. So until the Fed fully pivots, I don't see this moving. I see this more in a trading range near term. Short-term rates continue to grind lower, SHY grinding higher, but no breakout to show an imminent cutting of interest rates, and that's what we'll be watching. And that will be also a sign that things in the economy are getting far worse and creating the impetus for a Fed cutting rates. J&K to the IEF, this is basically a proxy for the yield spread on junk bonds compared to treasuries. If this is moving higher and it hasn't broken down, then that is a positive for equity markets. If this can roll over, right, you're getting a bit of divergence here. You're getting, you made a lower high, you made another lower high, you made a lower low. So this is still in the context, longer term, in a downtrend. Okay, let's go to a weekly. This peaked in May of last year, April of last year, and it's now in a downtrend. Okay, I could pop over to, let's do this so you can get a sense of what this looks like. Let me just go to option adjusted spread. Here we go. Well, this is the master, this is everything. But you can see this has been in a downtrend, which is positive for equity markets, really since October of last year. Okay, but it's been an uptrend since January of last year. So let me zoom in a little bit more. Let's go just 1-year chart. So yes, this is pulled back, but it's not broken this longer term uptrend of yield spreads widening out. Okay. We've just kind of gotten back to where we were, let's see, February of last year. Okay. So something I'm watching to see if this will break lower. Till it does, you still have to be relatively constructive on equity markets. Okay. So let's move on, and we're going to talk a bit about gold. First, we'll start with the dollar. We know the dollar has been weak. Okay. And remains weak. It's getting a bit of divergence here on the MACD, so I could see a bounce going into the Fed meeting. Is the Fed going to be a bit more hawkish than the market is hoping? I think that is certainly a possibility. Now that the market has moved, as we talked at the top, market has moved to a space where they're expecting a more dovish Fed, and maybe they don't get that. So we'll see. But let's look at gold. Gold remains strong. It's a bit overbought. You can see that MACD turning here a bit, but in context, this is strong, right? So, does this pull back to the 50-day? I could see that a possibility. You can see this attempted breakout and breakdown. This is going to be support. So maybe this just gets into a more of a consolidation phase, and that's kind of what I'm expecting. Okay, and you can see that GDX also likely into a consolidation phase. Let's go to the GDX to the GLD. That remains in an uptrend, so no real issue there. Let's go silver to gold ratio. That one's getting broke lower on Monday, but rallied back, still holding some major support there. So I don't see really any issues. Still overall bullish on the precious metal space. Energy, bit of pullback on Friday, but overall a good week, and technically looks rock solid. The strengthened materials sector, that also strengthened this week. A very good week for materials overall, and remains in that uptrend. The transportation index also solid week, kind of consolidating. Nothing of interest there. Let's go to the IAI to KBE. So what are the investment banks doing compared to the commercial banks? And what you see here is that's rolling over. So that's the first sign here that things could be breaking lower. Okay. So that the broker dealers, the investment banks, they are struggling. Not struggling, but they're rolling over. They're not gaining strength anymore. They are showing signs of relative weakness. And of all the kind of leading indicators in the market, this is the first one that is starting to roll over. So, it's one indication. You never use one thing as an impetus to buy or sell a security or a particular strategy, but you're an umpire calling balls and strikes. And, there's been a lot of nice, comfy balls, right, thrown at the market. The market's easily passed them, but this is one strike, right? One strike against the market. That's one strike, but there needs to be multiple strikes for it to line up to, hey, the market's going to roll over, okay, from the recent bullishness. But you have to keep an eye on these things, and that's what you're seeing there. You have the XLY to the XLP, so consumer discretionary versus consumer staples. That remains strong, so nothing doing there. ARC remains strong as well. Getting that bounce, oversold bounce. Look at this. This is where you get that tax loss selling into the year, and you're getting a snapback rally. But does that mean there is a true long-term trend change? I don't think so. I think this is more of a nice bounce before another rollover in the future. But hey, could be wrong. But that's where we're at. Still near-term bullish going into the Fed meeting, but right now, one strike against the market, but not enough to really stack up in the bears' favor. So at the current time, the bulls remain in charge. All right. I thank you all for tuning in to this channel as well as our podcast, InvestTalk. And I hope you have a wonderful weekend. A reminder, the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a great weekend.